Well, I finally made it, so third time's a charm. Anyway, I am currently, you guys can hear me, but I can't hear you, so something happened to my sound, but we'll just go forward anyway, so it's no big deal. So primarily, what do we trade? Well, at Power Cycle Trading, we started out just pretty much trading options, but with our system we've used, we trade now pretty much everything. S&P futures, crude oil, gold, NASDAQ 100 futures, and then the various stocks. So what I wanted to show you today is, well, we just had one trade set up here for crude oil, and what we've developed over the years. I've been trading for over 30 years, and so what I've always strived for is to develop a system that was simple enough that you could use it across all markets and time frames. And so we've developed the trading system we currently use, and now we've got the system, also an automated version of it with Thinkorswim. So that's what you're seeing here, on this screen. So basically what I'll do is I'll take you through kind of the general indicators and the setups. So we incorporate quite a few things in it. And before I get going too far, I'm having a raffle. If you guys want to enter it, I'll put it up for you, and you can just sign up for it, and then there will be a winner, and you'll get, basically, there it is. You will get my trading system, the course system, which will just tell you all the indicators, how to set them up, videos, the whole thing, tell you all about the system. Plus, you'll get a lot of other good bennies. I'll show you that real quick, and then we can go through it a little bit later towards the end. Let's see. Hold on a second here. Bear with me. So let's see. Can you see that now? Yikes, that's scary. It's kind of lagging, isn't it? I'm looking at the other monitor. Let me try something here. Okay, this is better. So let me just put this up real quick, and I'll show you. If whoever's interested, please sign up for this raffle. And first off, though, just putting up the old disclaimer here. This is strictly for educational purposes only today. So anything said is not constituted as advice. It should not be taken as recommendations. But anyway, the raffle, you got that link. So just put your name, email address in it. And I just was at the Money Show, and this was the special that we had for that. So if you're interested in the raffle, this is what you'll win. So you'll win the trading course. You get a choice. I've got 3 different courses. One's for swing trading, the other 2 are day trading. You'll get my fundamental technical trading course, options trading made simple, 2 months to our trading room, 2 months to the daily aftermarket outlook, and also included will be a live 90-minute webinar for this. So a lot of great value here. And this is what you'll get for the lucky raffle winner. If you're not the lucky raffle winner, you can still order this. You just go to powercycletrading.com/special, and you can get all of this for that really nice price. Here's that link. I'll put that up. So we'll do that. Hopefully we'll announce that at the end here today. So let me take that off. And get back to the system here. That's what everybody wants to see. So basically started off here with crude because I saw this setting up as I was getting ready. I was just flipping through looking at different markets. And as you know, trading is about setups. And what I like to tell our members, other traders, is that when you're trading, you're basically it's like you're a cougar, a jaguar, or jaguar or tiger or something. You're sitting there looking for your prey, and you've got to be patient and patiently wait for the setup, right? Or wait for your prey, and then take the take the prey down and take the trigger that your system's giving you. So basically what you can see here, it's pretty clear, is that we've got a crude oil trade here that we got signaled right there. That came at 11:30 Central, 12:30 Eastern. And you got another pattern recognition here. This is what we call a 5-bar reversal, and this is just a reversal bar pattern. Now this model that we have, I always use multiple time frames for the trading. And what I look at is I look at a 5-minute time frame, and if you hear that bell, we have automated alerts that you can put on, and all these lines and all this crazy stuff you see, you can take down any of this. This is all on Thinkorswim. This is done in ThinkScript, and it's the only platform that we have the automated setups for. Now, the actual trading model that you will get in that trading course, we can use it on any type of platform: NinjaTrader, eSignal, TradeStation, and I use TradeStation. I have NinjaTrader. But this, and also Thinkorswim, but then we've modeled this for Thinkorswim because it's just a great platform in general for options, and plus the system itself would be good for MT4, but I don't have it automated for anything but Thinkorswim. And we kind of, we're not getting anything from Thinkorswim, but it's just the way it kind of happens because my partner on the platform that actually does all the modeling, he's a PhD in neuroscience, and he's just a real awesome computer guy and great trader. So we've taken the system and then we've automated it here that you can see. And then what we've also included in it is you'll see a lot of these various lines across here. So these are various support resistance type lines that we use for our day trading. Now we use the same model here for swing trading too, and I'll get into that as well. But what you're seeing here, when you see these different lines here, like this kind of bluish dotted line here, this is a Fibonacci ratio line. So what we have is we have multiple support resistance lines that we put in. And when you day trade, I guess everybody here is probably a day trader or swing traders. So you know that markets every market has a different rhythm to it, and they all go, different particular amounts of moves. Anything from 4 to 5 to 8 ticks to 10 ticks. Like NASDAQ 100 will move in kind of 4-tick increments, and usually 2 points or 8 ticks is kind of usually a good move. So that's $40 a contract. Whereas crude tends to move in 5-6 ticks to 10-tick increments, which is $50 to $100 a contract. So number one, you need to decide as a trader what you're going to trade, and you need to determine the rhythm of it and see if that fits your style. So the system, though, can be set up to trade anything. It's just a matter of what you want to trade personally that fits your style, that fits your risk parameters, your profile, that type of stuff. Your emotions as a trader. Some people don't like to trade crude because it's too whippy and it can move up and down kind of violently. And same for gold. Now, other people like to trade gold, and some people like to trade the S and NASDAQ 100. So in our room, we tend to trade on the day trading. We'll trade the NASDAQ 100. We have some traders that just like to trade the ES, and then we also look at gold and crude. And then if there's anything setting up for maybe an option trade, we'll look at that as well. So yeah, each market has its own little fractal or rhythm, I call it. And so you can see here just on this, we've got this different lines. I'll kind of explain what they are. I'm a big fan of always knowing where your major support resistance levels are for day trading or anything for that matter, but very much so for day trading, because you'll see markets move up and then they stop. And if you didn't have these lines on it, you'd just be thinking, oh, it's going to go and go. But then all of a sudden it stops. So what you're seeing here is this is a Fibonacci level, and this is based off of pivot, prior day's pivot point. And if I scroll up here, you'll see it. I'll just pull up. This is a 200 tick right here. And let me just go through. I use the 5-minute right here, and that's what I call my anchor. Now, the 5-minute tick data was one of the first short-term tick intervals used when they first started putting putting out technical or charts. Back in the 80s, you had the 5-minute time frame was like one of the shortest or the shortest time frame period. So a lot of trading systems are still, basically modeled off using a 5-minute time frame. So I find it's an excellent time frame just to show the intraday trend in general. Now I don't trigger off the 5-minute time frame. For that, we'll go to a shorter time frame. So this next chart here is a 400 tick, and then this is a 200 tick, and this is a 133 tick chart. Now, the 400 is an excellent for also showing you trend and cycle. It's not real fast, so you can see a trend and cycle a little bit better with it. And then I like to trigger off of either the 200, which is this chart here, and the 133. And I have different, trigger points. But what we've found is that we've incorporated also different candlestick patterns. And so the main candlestick patterns that we really like are the engulfing candles, which you can see here, and this is identified by this blue arrow. These are automated, and by this kind of taupey color brown arrow. Do you guys have sound now? Okay. So this is one of my favorite setups here, and that's when you see it on the 400 and you see it on the 200. So right here you can see up here earlier in the day, this came at about 11 o'clock. We had this engulfing bar here, and this red dashed horizontal line here, this is the prior day's low. So you need to always monitor, okay, prior day's open. Well, open is not as important as, to me, as the close and the high and the low. So this is the prior day's low, and I'll open this chart up so you can see more of the ranges, and I'll show you what the lines are. So this is the 200 extended or maximized, and let me make this chart a little bit smaller, or zoom in more, or zoom out, I guess you'd say, more. And so you should be seeing this chart. Everybody see this chart okay? I see somebody says no video. Okay, great. So what we have here, these are our Fibonacci-based lines here, and these are all color-coded different colors to show you the different support level. And these are all based on ratios, Fibonacci ratios off of our pivot point. So these rounded type of horizontal lines are denoted as, these are the fib levels. So you can see this green one, you can see this blue one here, and the ones here, this gray one is also an intermediate term fib level. And then the this square horizontal line here is a low, it's colored in red. So if we go up here, I'll scroll this up a little bit so you can see it better. Scroll it down so you can see the lines above. You got to scroll it way down. So if right now you don't see any price action up here, but this is based on the prior day's pivot point. So this is we call a pivot point. And then off this pivot point, we take our Fibonacci ratios, we calculate those out, they're automated, and they're drawn in. Now this white line is the prior day's close. So these are all important support resistance. And then we'll have other various support lines, like this is an hourly high, and we'll have different increments, because there are a lot of systems that work off of different things. So if you know what's working and you kind of mimic it, you'll know where potential supply zones and demand zones are, so you can trade off of those. So we look at all that. But the meat and potatoes of this system is, knowing where major support resistance is. So these fib levels are just amazingly accurate. You can see here where the market stopped, right up here at 1030. This is a fib level based on that pivot point, and it came down. It's been trading between these two Fibonacci levels. So for the day, if you just look at the 200 here, let me just pull this forward. There have been a couple of good signals here, and the best ones that I like, the ones that are, I call the higher probability and more selective type trades, is that when you get kind of a cycle low, we like to look for cycle lows and cycle highs, and then what we call the volatility compression breakout type trades. So here you can see this also, identifies when when the price goes into what we call consolidation, or also we call a volatility compression. So it's signified or indicated by a dot starting. Now these dots also they also have another little indicator programmed into it. And so when it's green, the probability is it break to the upside. When it's yellow, the probability to break to the downside. Now these are just basically a compression squeeze, and this is all also explained in the course. So if you don't have this automated, you can still, it'll still teach you how to set up your whatever platform charts you're using, so you can do the same thing. You just won't have it quite as fancy as what we have here. So what I like to look for is like a cycle low, and you can see here price comes down and it comes in. What really creates a good cycle low or cycle high is when you come into a major support level or major resistance level, market stalls out and the momentum shifts and then turns the different direction. So you can see here, this is just on crude oil. Market came down, you can see it started chopping around, and then the lower steady indicators turned up. Engulfing candle here. We have our moving averages. We like to look at the 15 and the 50, and you can see price reversed and a nice move to the upside. So very clean pattern here. Now the other thing too is we want to look at this with multiple time, not rely on one, because a lot of these things are lagging. So we want to have other time frames, the longer time frames. We want to have kind of everything going in the same direction. And what tends to happen, so here everything's lined up in the same direction. Let me turn that sound down. It's driving me crazy. Is that better? Okay, so what you're seeing here is, market comes down, we get the indicators turn up. So we have this on the 11:30 Central, and then we also, everything's turning up on all time frames. So let me get this lined up. Yeah, so okay, so everything's turning up on the multiple time frames. So that was at 11:30, and you can see here we had this. This is a different pattern. This is called a 5-bar engulfing, our reversal pattern. It's based on 5 bars, and this is all automated, so you don't have to, kind of do it yourself. But these are very, very nice setups. So you can see this is a very nice cycle low. Now the other thing we like to look at, you'll notice these candles look maybe a little bit different to you. What I will do is we use what we call the Heikin-Ashi candles for the longer term time frames. I like to look at them because they also kind of show trend. So you can see this right now is on the crude oil. You can see when it's moving down, these are unshaven tops, and it's also a good trend indicator to show you how strong the move is. So then it reverses. You get that reversal right here. You can see the engulfing candle there. The lower steady indicators turn up, so it's a pretty decent indication of a cycle shift to the upside. Now the other thing that you'll notice once you got into this trade is that where did it stop? Well, it came up here and it stopped right into this Fibonacci level right there and right into these moving averages. So what we'll look at doing is for our trades, we'll look at getting in on the cycle low, and then we're going to look at taking off profit, getting out at profit take into this major resistance level. So here you would have gotten in at about 93.70 and gotten out at about 93.80 before this major resistance. So that's good for 5 ticks to 10 ticks. So that's $50 to $100 if you're trading crude. So that's that's just one trade that I noticed here standing around when I was waiting to come into the room. Now the other type of trade setups, and I'll show you the various different ones, is what we call the volatility compression squeeze, and this is one of my favorites for trading gold. It's about the only type of trade I'll take on gold. So let me pull up gold, and I'll show you what I'm talking about. Now, you'll see gold here is just a really choppy mess. So I'm not going to even stay here very long because there's not a lot of good trades here on gold. I'm going to move back here. I'm going to open this up, see if I see a compression squeeze from earlier. Let me get this a little bit better. But you can see right here, this is a good example. This was at 7:40 in the morning. You can see where the squeeze started right here at about 6:27 a.m. Central. And then it went for about 1, 2, 3, 4, 5, 6, 7 bars. And this is a 200 tick chart. So what we like to look for is to be positioned for when the squeeze triggers, okay? So you've got your compression, volatility comes in, and then it's like, you know, holding a little puppy or a baby. Sooner or later that energy is going to come out of it. That baby's not going to let you hold it for very, very long, and then you're going to get a big pop to the upside or downside. And I tend to like to trade gold, and crude is good too for these breakout type compressions, but gold is the best one that I've found. So when it does trigger, it has great momentum bursts. So you can usually make 10 ticks to 15 ticks really fast, which is $100 to 150 or 200 or even more. So what we'll do here is when we see these type of pattern setups, we'll just put a OCO order in. One cancels the other, and we'll just sit it there. So right, for example, here you can see 1238.80. So I put in a order to buy at around maybe 1235, 1235.20. So I just have my order set there, fixed, and I'm looking at my lower studies, so the probability is it's going to go up. Now I also have the squeeze indicator here on this lower study so I can see. So when it does trigger, I get hit, it cancels my stop below it. You know, one cancels the other, and then I've got an automated stop in there. So what I usually will have is an 8-tick stop and a 10 to 15 tick profit target or profit stop. So on this particular trade, if you been here with your OCO order, that was at 1234.90, and it went pretty fast to 1237.60. That's about a $200 move right there, really fast. So then if you want, you can also trail and try to stay in for the longer ride. So that's another trade setup that we like to look at, and that's based on what we call that volatility compression squeeze. Now, so that's gold. Now a lot of during the day, we're going to really like to follow the ES and NQ a lot because the margins are low. It's a good one to trade if you're day trading because margins are low and it's very liquid. So I'll switch it over to NQ and see what's been going on there. But that was the best trade, was that crude oil trade right there at the bottom of the hour. So so here is the NASDAQ 100. It's a pretty popular contract to trade, and you can see how now this time of the day, see how whippy these bars are. So these are not really good patterns to trade. You want something that's a little bit tighter bars. So we can just pull it up. Right now we're getting a cycle low. You can see the lower steady indicators on the 5-minute are starting to turn up. We have 2 engulfing bars here. So right now this is a long setup. So you'd want to be taken in a long. So right now on NQ, you'd be buying right now. And then the first level of resistance is going to be right here. This trend line we also like to look at trend lines. So this is an automated trend line based on pivot highs or swing highs and swing lows, and it'll put in pivot points to draw the trend lines. You can see it's breaking the trend line. So right now this would be a good setup right here right at this level here, about 34.29. It's going to have to hold here 34.30. This is your 50 moving average. Breaks through that. There's really not much resistance until 34.31, this is a 5-minute opening range low. and then this Fibonacci level. So this right now has good potential to get back up here into this area here, which are these pivot highs, we call them. So a lot of times you'll see markets retrace or move back to prior highs. So right now you can see it pulling back right there, but with the momentum and everything starting to shift, it should continue on up here to this area here. So here would be another trade setup right there based on the 400 engulfing candles, 5-minute turning up. Now you can also see that the background colors changed, and so that this system here that we have lined up for Thinkorswim is very visual. So the indicators will also change the color of the background. So when certain things happen within our model, the background color will change. Right now it's neutral, it's black, and you saw it turn red a little bit. So you could see that the momentum did come out of it, and you can see now the market kind of went dead. And this will turn green when all the indicators are turning up at the same time. So there's a lot of different things that are interchanged into the model to give a lot of visual components to it. The other thing is the moving averages will change color when slope shifts. So you can see here it was a kind of a brighter purple when the moving average was at a steeper angle. Nice slope to it. Started turning white when it flattens out, and then it'll turn another color. It'll start turning red when it starts rolling over. So a lot of visual factors here to use. So we have automated trend lines, various support resistance based on Fibonacci, and then we have our compression squeeze indicator and our lower studies for the momentum and direction of a trend. So that's kind of it in a nutshell as far as describing kind of the indicators. Now, when you come into the trading room and you get the trading course, it goes through all this in detail with videos and everything else. So, rather than me explaining it in 30 minutes, you can sit back and, study the course and set up the indicators and take as long as you want. And then you come in the trading room and ask questions to better educate yourself. These are available. Well, this is our coded indicators, and this is available on Thinkorswim. But the code, we have to import the code into your Thinkorswim platform, which will give you the code, and then you do that. Now, if you're not TD Ameritrade, if you open an account, the Thinkorswim platform is a free platform. So once you have an account there, you can get you can get the Thinkorswim platform. And then also, most of the time, TD Ameritrade, they'll let you open an account and initially without funding it, so you can get into it. They're really lenient, and you can do a lot of great stuff with them. They have probably one of the best option platforms too. And again, I'm not a spokesman for TD Ameritrade, but I like their product a lot. I actually use TradeStation for my execution because I started out with them years ago, and I haven't really switched my money from there, but I have accounts at TD Ameritrade as well. So so here you can see the market still hanging in there. Another engulfing candle there, so it's still holding up. So you can trade accordingly with these patterns, but this is what we would call a cycle low. Market comes down. You can see how hard it came down on the 5-minute time frame. Finally found a little bit of a bottom in here to this Fibonacci level. You can see how it held there. Major support. These Fib levels are just unbelievably accurate. It's amazing how Fibonacci works, but it really does work. So it's something that you should pay attention to as a trader. And then you can see that the 5-minute time frame, this is what I call the anchor, starts to flatten out, hold, and the market starts turning. Now, when you're in a very, very volatile market where the market's really hitting down hard or hitting up hard, I'll give you one tip: follow the 5-minute time frame. Whatever time frames that you use for your trading, your day trading or whatever, or even swing trading, if you're looking for a good entry point, follow the 5-minute time frame as kind of that anchor time frame. Very key. Here's the raffle information again. Somebody asked for that. I'll put that up. So the other thing I want to show you, the other part of what we have is our scanner. And the scanner is based on the same trading model. And I'll show that to you, and it's a really great way to filter and scan for different trade setups. And I'm a big option trader. I love to trade options. That's kind of a big part of my background is trading options. And so, I mean, the day trading is day trading, and it's day trading is directional, and there's the special link that what you'll get. Now, if you don't win the raffle, you can still get that special if you're interested in that. So what I like to do with options is if I see a good day trade setup, you know, where you have a really hard down move or up move and you're seeing a bottoming pattern, then I like to look at, you know, options for day trades, you know, if I'm trading like an Apple or something. And what I'll do is I'll buy, you know, a high delta, like 60, 70 delta, or I'll sell puts. I'll sell puts at the money or a little bit out of the money and play it that way. And I really like to do that as well towards option expiration when that time decay is a real critical key factor there. So there's a lot of different ways to do, you know, to do your trading. And then I also teach a lot of different option courses on how to trade weekly options. But this is just, you know, one part of what we have. So you can still see this NASDAQ is still in the trend. It's very, very slow. This time of day, markets are very, very slow. So let me open this up and you can see what's happened so far today. And then I'll show you the scanner and how we use that. Hold on a second here. Bear with me. Darn. Sometimes we've got this program that has so much into it. Sometimes the system gets frozen a little bit. Here we go. So let me just change this up. Okay, here we go. Get a little bit better here. Okay. So you can just see here on the NASDAQ here, you can put anything in here. I mean, I'm just using the NASDAQ because it's kind of one of the main futures that we like to follow. But so here's a great example. Earlier, when the market opened, you know, you can see the market opens up at 8:30. You get a move. This is a major Fibonacci level here. Look how it just nailed it to the upside. I mean, it just did not go past it. So when we're trading and we see this, we call it the purple line or the white line, buy into this thing, we're going to look at selling that the first time up. And then it pulls back, goes up there again, second time up, fails, third time it didn't even get up there. So, you know, when I'm teaching trading, you know, these major support resistance levels, you can think of them as like a tree limb. You know, the first time up through a big tree limb, forget it, you're not going to get through it. You get up there again, you chop a little bit more off, chop a little bit more off. Now this time, if it had gotten up here again on the third, fourth time, then there's a higher probability it's going to break through, but it didn't. And so here it breaks down. We had a squeeze, you can see here. So right here, you know, breaking through this major support, you could have gone short, and here's your moving average that it held into on the 15. Now we call this a retrace. There would be a great setup to short it there on the retrace, and then down she goes. And then this was that really great buy opportunity because the 5-minute flattened out. Criteria for support and resistance, Fibonacci, and also prior days trading ranges, and different opening ranges and different hourly ranges. So we have different combinations. You can see this yellow line, dash line. These are also based on intraday trading ranges. And these are automated, but you know, in the course it'll tell you what the main support resistance we look at. On the moving averages, we like to look at the 15 and the 50, and here's what we call a retrace trade. So the market had broken down, goes up, set your short there, boom, down she goes. And then this was your cycle low trade, came down into the prior day's close. This white line is yesterday or Friday's close, held, reversal bar pattern, indicators turned up, boom. Nice trade set up there. Came up, kind of fizzled out here, didn't even get up to the fib level there. And then chops around. You want to, avoid it when it's in here in this chop zone. But so I like to show selective trades. That was a very, very selective trade. And then you stay away from it until you see another, good trade setup. Now, here was another opportunity. Here is when it came back down, retested the prior day's high again. You had these two reversal bars that's telling you the market's trying to figure out if it wants to hold. And it did. It pops back up and goes back into this fib level there. So these are the kind of trading patterns that we look at all day and teach in the trading room. And here's another nice engulfing to the upside. You can see the lower steady indicators turned down. So it lost momentum into this fib level. Back down she goes into the 50, holds here. On. So a lot of good stuff there. So before I run out of time, I want to show you the scanner and how we use that. And this is something that's really cool. It really saves if you're a day trader or swing trader to have this. It's a really valuable tool. And so what you're seeing here is a matrix, and you can put in whatever you want. And we've got it color coded. So when you see a color of green, that means it's in a squeeze. If you see a minus in front of it, that means the probability is for that squeeze to trigger to the downside. If you don't see it, if you see it just a regular number, that's a probability to the upside that's a long. Now, that means it's already triggered. So this gives you a chance to look at it. Maybe you want to get in. So for example, here's Netflix. It was in a daily squeeze. So I can shift over to my charts, Netflix right here, pull that up. And what I like to do is when I find a trigger, I like to use options, and I'll do different option strategies. I'll sell credit spreads, or I might look to buy options, but that's a whole nother methodology and course in itself. Let me pull up the different chart for this. What I teach is, how to look at what to do with implied volatility for these type of trades. You can see here, this is an implied volatility chart. The problem right now with credit spreads is implied volatility is so low because the markets have been just grinding up. So volatility has really come off. So when you find a nice trade setup, you can afford to maybe buy the deeper in the money calls because they'll be fairly cheap. So you can see here Netflix, this is on a weekly. Let me put it on a daily. Yeah, sorry about that. There seems to be a problem with some browsers that have a hard time taking that box. So I don't know if you maybe use a different browser. I know a lot of other people have probably gone in and used it. So apologize, but I think it has an issue with browsers. So here's a trade that you guys might want to keep an eye on. This is Netflix. So you can see it's in a compression squeeze on the daily. It's been in a squeeze since the 6th of November. And it just triggered last week. So you can see it's holding on this trend line. Now what I like to look for is here you're coming in, here's where Fibonacci also comes in. So here's your extension high. This is a swing high and a swing low right there. So I'm going to look for a break. When it starts breaking this 50, it's having a hard time on the 50, but when it starts getting through this 618, that's when you're going to start seeing some big momentum to the upside, and there's a chance that it's a good high probability chance it'll go back and take out that high. Now, you can see after that high, then I like to look at extensions on my Fibonacci level. So here's the 1272 and the 1618, and then once it gets up here to the high, once you get through that 618, very high probability it's going to go back to the prior high, and then you've got a very high probability it's going to go to that 1272 extension. So then I like to look at option trades to take advantage of that. So, the different trades I'll look at, I will look at if it's a really powerful trade, I will look at a back ratio type option spreads, and I'll also always look at credit spreads selling 1 standard deviation out or 2 standard deviations out. So those are type of things that I teach in my option courses. But here you can see Netflix right now is on a 5-minute squeeze. And so what I like to do is I like to look for an hourly squeeze or an hourly setup along with the daily. So that's a weekly. Let me put the daily up here. So right now we've triggered, so there's a good probability that when you do have a squeeze trigger, it usually lasts, anywhere from 5 to 8 bars in the direction of the trigger. So right now it's just, this is a kind of not a really great week for setting up new trades because it's going to be a short week. You can see the implied volatility on these things has really come off. So based on all that, there's always going to be a trade out there, but this is one trade I've been looking at. But there's not a whole lot of momentum. But here's the 1 hour, and your squeeze on that. So what I'll be looking at is if it starts to trigger to the upside here, which it hasn't, then the first trade I usually like to do is sell a 1 standard deviation out of the money credit spread, so a bull put credit spread. And then I might look to do here maybe a call debit spread, and it depends on the time frame. So there are a lot of factors that go in, but the first thing I'll do is I'll look, hopefully the implied volatility gets a little bit better, and I'd look to sell 1 standard deviation out. Now, when you're selling option spreads, does everybody understand standard deviations and why to use that? Do you understand the market makers, what they do when they're trading spreads? Well, see, the other thing you can do in option day trade too, like here, this is what an option day trade. If you find something in a squeeze, I'll teach you a real quick lesson here on volatility. When you find something in a squeeze, like Netflix, it's just triggered on the daily. So there's a high probability here. See this 5-minute squeeze? This thing's not going to sit here for forever, right? So it's either going to break up hard or break down. Right now, the indicators are telling you to the upside. So when Netflix starts breaking this 348 to 348.5, then if you're an option day trader, this is when you want to start, buy your 60, 70 delta options or sell some puts. Okay, so watch your squeeze, and you can, if you don't have a squeeze indicator, then my course will teach you how to set it up so you can look for these squeeze type trade setups with whatever platform you have. Now this is automated for Thinkorswim, and which you can also get to once you become a member. You can buy our package for this. So this would be a trade setup to watch. And as a trader, you have to be patient and wait for these setups. They don't always happen, right? So you have to be ready for them, and then you have to think, okay, what's my trade strategy that I'm going to use? So what I'll be looking at, and it doesn't look like it's going to happen today, but I'll be looking at Netflix here, and I'll be looking at the 5-minute time frame, and I'll look at the other time frames too. See, this is not in a squeeze on the 15. The 30 is in a time squeeze. So this Netflix has potential to have a big break up or down. Now right now it says the break's going to probably happen to the upside. So I'll be watching this close. So when you come in during the day, first thing in the morning, take a look at Netflix and look on your 5-minute time frame if you're a day trader. And if you start seeing Netflix start breaking above this this 50% retracement right here, this right around this, right about where we are now, then jump on board. Let me do something here. I'm going to show you Fibonacci retracement with your extensions and then standard deviation real quick. And how much time do I have left, guys? I've got, am I doing all right, Morgan? Okay, great. I got plenty of time. So first off, for your fib levels, and this is how you do it each and every time, just put in your Fibonacci retracement. Whatever platform you have will have it, and then you want to go to the prior pivot high. This is what we call a swing trade pivot high. That's the high point, right? Use that as your first data point. Then come down to your pivot low. So you can see here then your retracement levels. So right now we're in that 50% retracement, so it's just kind of, you know, stalled out. And also, you know, we're into Thanksgiving, so, you know, people will be taking off and there's not a lot of trade, and we're towards the end of the year. Now, when this thing starts breaking on the 30-minute time frame, well, actually the 5-minute, if you're a day trader, you want to monitor closely the 5-minute. So when it starts breaking above this 348.05, and give yourself some room, say call it 348.5, then that's when you could look to buy some deep in the money calls, weekly calls. They'll be cheaper. And also the other thing that if you're an option trader or a day trader, you want to make sure that, you know, if you're trading these things on a Friday, its expiration, you know, volatility is going to be stripped out. Also, all the time decay will be stripped out, so you'll get stuck where these options will get really cheap. So you buy those 70 delta calls, but you don't want to sit on long because you'll end up making no money. So what I'll usually do on Friday expiration, instead of after about the first hour and a half, instead of buying premium, if this breaks out, I'll sell, you know, I'll sell at the money puts or a little bit below, and just trade it that way and look for that time decay to go to zero. So that's one thing I like to do. So for the rest of this week, if you want, follow Netflix here. Now, once again it goes to that 618, then you're going to have more momentum coming in. A lot of trading models will be keying off of that, and then this will be your ultimate target, that 1272. If you can get through that 618, then you can go out and start playing these options for a move to that pivot high, and then possibility to 400. Let's take a look at Apple. Apple also, let me pull up the scanner. Now, the thing about the scanner too with Thinkorswim is that you can go in here and you can go to, you can set up, you can scan on, they have just so many different things you can scan. You can scan all ETFs, you can scan, you know, futures, Forex, you know, top 10 stocks that are trading. You come down here to weeklies down here, you can find all the weekly options. So it gives you a lot of different things that you can scan for. On this list I have open is just kind of my private list. And so I just put in what I like to follow. And, you know, you get familiar, you know, as a trader, there's certain things that you follow all the time, and you get kind of familiar with the way they trade. And, you know, you can just go back to the well over and over and over. So there are about 10 stocks I'll look at over and over and over. The 5-minute. I like the 5-minute because it's the shorter time frame for intraday. Just over experience of me following the markets, the 5-minute time frame has usually been a very, what I call the anchors, trend indicator for intraday, 5-minute. And again, the reason, well, I'm not sure 100%, but my theory is that when they first started having data, where you first started having charts, the shortest time frame that they kept, that they had charts for, were the 5-minute time frame. So when you have systems that are being tested and back tested, the data that you have the most of is the 5-minute time frame. So a lot of these algorithmic systems are going to be tested a lot of times on the 5-minute data stream. So it tends to have a pretty good effect on the market. So that's the reason I like to follow that 5-minute for my anchor for intraday trading. Or for breakouts, if you're trying to get into a good swing trade, the optimum point is to get in when that 5-minute, you know, on your system, whatever you use, breaks out. So I like that a lot. So here is so here is going through here. What I'll look at, what I like to do is try to find a weekly, a daily, and a 60-minute squeeze all together. So I can sort, you know, here's a weekly, I can click on weekly and I can sort for a weekly time frame. So let's just say, for example, right now, eBay, see eBay right here? It's got a -4 on a weekly. So that says that eBay's in a squeeze on a weekly, and the probability is for it to break to the downside. So this could be a long this could be a longer term move for eBay to the downside. I'll pull that up in a minute. I'm also looking at some other things. Here's another one. This is the FXY, which is the yen. It's in a weekly squeeze to the downside, so this could be a sustained move to the downside. Here's another one, FFIV. Here's a weekly on the FFIV, and it just triggered to the downside on the daily, so let's pull that up. So by having the scanner, I don't have to flip through hundreds of charts every night. I can just come in here in the morning and say, oh, that looks interesting. Let me see what's going on with FFIV. And I can just click on it. It's linked to my charts here. And I can see what right now that, I've got my scanner goes from 1 minute, I can go all the way up to monthly, so I can do 1 minute, 2 minute, whatever, but I've got it set for 1 minute, 5 minute, 15, 30. And I find it that I really kind of tend to follow the 60-minute, daily, weekly. If I can get those in a squeeze and start triggering, they give you a lot of possible trade setups. And then for the day trader, the 5 minutes is a good one to look at. So we were looking at FFIV, so let's take a look at it, see what it's telling us. So if I pull it up to my main charts here, I've got my daily here, and I've got a 5 minute here. You can see it's pretty much drifted to the downside. Now let's pull up an hourly. And we also had the weekly. I think it was the weekly was in a squeeze. So you see it's breaking down, but this is pretty interesting here. If you look at the weekly, it's already triggered. Hold on. What were we saying here? Let me pull this back up. FFIV. Okay, here's FFIV here. If you go over, it triggered on the daily. That's in yellow. So once we've had a trigger, we color code it yellow. But it's still in a squeeze on the weekly. So let's take a look on that weekly. And it says it's a minus 3.5. We have this also ranked by strength from 1 to 5 based on our model parameters, and a 5 being the strongest. And here's Apache oil. It's a minus 5 on a weekly. So we'll take a look at that too. And then these things you have to just go through and then look at the patterns, and then you can put together the strategy you want to use for your trades. And I usually will always use options. And they're different, the main strategies I always look at are credit spreads, just buying like a 70 delta if I'm real bullish or bearish on something. And I'll look at iron condors if things are totally sideways with no momentum to the upside or downside. And then if you have a major reversal or major trend change, I'll look at a back ratio spread, which gives you unlimited upside with a fixed amount of risk. Which are really great trade setups. So here, looking at, we were looking at FFIV. Okay, so here you can see it's in a squeeze. See, it started here. It's been in a squeeze for 2 weeks. So right now, I'll pull up the daily. The daily was in a little squeeze here. It triggered, but it's really very consolidating sideways. So with FFIV, the weekly's in a squeeze. The daily triggered to the downside. You can see the trend line here. You can see it's below the 15 EMA. I will also look at the 8 EMA, the 21 on the longer term trades, and it's below the 50. So on this trade, I could look at possibly doing some type of a call credit spread. So I'd sell, but the problem is right now the problem I'm having is that implied volatility is so low you can't get much for these spreads. So this one I would look at probably some type of call credit spread, a bear call credit spread. Might look at buying puts a little bit further out, and we can look at that. But this is a potential trade setup. You can see it's rolled over. It's coming in here, and 78, this area down here will be first support. That's why I like to look at credit spreads, because even if you aren't totally right on your timing on the direction, even if it just goes sideways, you'll make money on that time decay and the thing going to zero. So FFIV, we can look at the options. Let's look at the implied volatility on that. It's going to be low, which is a problem. That's not the one. See, this is the problem. Not getting much premium. Look at that. Look at the implied volatility. This yellow line here, it's just been crushed. Just just all the volatility's just been sucked out of it. So on this particular one, it might be worth just buying some puts. I'm not, I'd have to look at it a little bit more, but we could go look real quick. So pull up my option chain. We'll put in FFIV. One that really looks good too is Goldman Sachs. I'll pull that up next. Here's FFIV. Right now, the indicators are telling us that directionally it's potentially going to move more to the downside. That's on a weekly, so I mean that could change. But if we're just kind of look out, here's the December. Got 25 days on this. Then we've got the weekly here. I'd probably go out, since it's in a weekly squeeze with potential break to the downside, I'd probably look out to this 25 days. And I'd probably do a put spread, because if it does just kind of drift sideways, if you have a short leg, you're going to help you on any time decay. So on this trade, I might look at, while I'm here, I'll teach you standard deviation real quick. Most market makers, if you think of the market, a bell curve, I don't think, is there a drawing tool here? Looking for a drawing tool. Question: if a lot of people trade, how do you get an edge? I'm not sure I understand that question. Use the arrow. 1 second here. I'm looking, just bear with, I'm not that familiar with this platform. I'm looking for the drawing tool. Arrow. Okay. I see tools down here. What I don't want to do is screw this thing up. Well, anyway, I'll try to highlight this. Can you see this pointer? Okay. So, standard deviation is just a normal distribution curve. So if you can kind of follow this, so you have that bell curve, it goes up like that. And then you're going to have a one standard deviation is basically about 69.5%. So what tends to happen statistically is prices will fall within that one standard deviation range, and that's where they'll close based on their expiration. So it's basically, the formula is based on the price of the underlying times the implied volatility times the days to expiration, upper right corner. Thank you. I know I've used this drawing tool before. Okay. Darn it. Whiteboard. Well, so anyway, basically price is going to move within a standard deviation. Statistically, they will expire between one standard deviation. So that's why market makers are tending to always sell you options, sell premium, because 70% of the time the price will fall between that standard deviation of 1. So 70% of the time it's going to expire worthless between one standard deviation. So if you want a quick rule of thumb for one standard deviation, you can come up on most platforms over here in the right hand corner. This is Thinkorswim. you can see this is the for 25 days left till expiration. Right now, one standard deviation is plus or minus $5. Gone very low. So this is not exact, but you take that plus about 10%. So let's call it 550. That would be one standard deviation. So currently it's trading at $81. So, you know, plus or minus, let's call it 6. That would be one standard deviation down. Plus 6 to the upside is one standard deviation up. So what it's telling you from just a back of the envelope quick look is that if you go to $87 right here, this is one standard deviation, 87.5, basically right here. That would be one standard deviation up, and then take off let's call it roughly $6 to the downside. So that's 75. So here's 75 to the downside. So here's the move. So right now, the market makers are saying the implied move over this contract for the next 25 days, based on where we are today, is that one standard deviation down would be 75 to the downside and about 87.5 to the upside. So you can see risk reward, the premiums are low, so you don't get much for your money, but you've got a 70% chance that this will fall between $75 and 87 or 87.5. So, you know, it's when the implied volatility is a little bit higher, you know, you're going to get more premium, but still you can sell these credit spreads. So here, if you sold the 75, 72.5, you could get 20 cents. That's not anything great, but you could also look at, a lot of times if you go 2 standard deviations out, you could sell the naked puts. But so this doesn't look that thrilling to do this strategy, but if you follow this over the course of time, the market makers are telling you right now that the downside's 75, the upside's 87.5. So the other way to look at it is if you're going to buy calls, so here's $53. That's a, let's look at what delta that is. See, that's a 17 delta. You don't want to buy a 17 delta because what it's saying is the other side of 70 is 30%, right? So if you bought the 87.5 calls, even though they're cheap at 56 cents, you're going to only have about a 30% chance that this stock will be at 87.5 on expiration. So those are the ways you have to evaluate what you're going to do as an option trader. So I hope I didn't go too far down a rabbit hole, but these are things that I look at. And you know, if you are going to trade options, you need to be aware of what the market makers are doing on the other side. So, so for this particular trade, you know, we were looking for it to move down. If you wanted to buy puts, you know, you should buy the deeper in the money puts. Probably you could do a put spread, so you might want to buy the 85. You know, here something like buy the 85, sell the 80 put spread. Not a great deal. 310. Your max profits $2. So here's your profile. Your max profit be 190. Not too great, but this is the analysis you have to go through. You have to go through what your risk reward is. I'd prefer to see something, you know, greater than 50%. This is you know, so I'd like to, you know, get into a spread like this for $250 rather than 300. So these are the little things that you have to look at. But anyway, I just want to show you that. The other one that looks pretty good was Oxy. It's already had a big chunk of its move, but let me show you that real quick. And again, this is a really nice little tool. Get your implied volatility, get your historic volatility. You can do this pretty much on, this is on Thinkorswim. They'll let you put that up so you can, you know, when you get the historic shooting up above the, I mean, implied versus historic shooting up, then this is a great place to be selling options. So right here. So for example, this was a trigger squeeze and it triggered to the downside, but if you'd sold options here, this was a great area. Look, you had your high implied volatility. You could have gotten a big, nice, juicy premium. The other thing I like to look at, I like to trade SPX with options. Let me pull that up real quick. I'm just giving you a wide brush of different things. So here's SPX. This is a CBOE, and these are great for trading options. Yeah, really tight spreads. These are really good for selling because they're also European options, so you don't have to worry about having anything. SPY is good too. The ETFs are really great for buying options because they're cheap. You don't have to worry about getting something put to you or getting called or exercised because they're European. They're financially settled. So the CBOE options and ETFs are really great for option traders because of that. And so what I like to look at is here you can see that it's just been trending up. And I'll show you what I did last week real quick. Okay, let me, here's on the weekly. What I'll be looking for here is a sign that momentum has shifted. Right now, it's a nice solid trend to the upside, so I'm not going to be selling any call credit spreads today. What I'll be looking for is to see if we get a little bit of a turnover here and a pullback. So last week, right here, it was right here. So I'm going to flip this over to candle. We had an engulfing candle to the downside. My momentum indicators turned down. So last week on sold a bear call credit spread here, collected about I think about $50 a contract and expired worthless. It was a nice easy trade. Let me change this to candle so you can see the engulfing. These I have up right now are the Hakanashi candles, but I'll change it over to regular candle. Okay, so see that engulfing candle there? And then see the lower studies? The cash settle means that there's no underlying ever exercised. You know, you just you make it or you have to lose it. So when I saw this engulfing candle last week and the indicators turning over on the daily and the 60 or 1 hour time frame right here, that's when I sold the vertical call credit spread 1 standard deviation out, and at that time that was the 810 815 call spread. And time decay started accelerating. The best time to do those are also like on a Tuesday, Wednesday really being the best, because then that theta decay just tanks. So here you can see on the 18th here on the hourly, see how it rolls over. So I'm watching as an option seller, I'm watching that daily, and I'm watching this 1 hour. So look how the 1 hour rolled over here. So then when this started happening and I saw the daily, I'll put the daily here. Let me shift this to the regular candles. Okay, so see that? And then the indicators are starting to roll. And here's my 1 hour time frame. Rolled over on that. Good setup. So right here. So right there, right in here, I sold that 1 standard deviation out of the money bear call credit spread. I believe it was at that time it was 110, 115 spread, and had a nice pullback here. And even though Friday moved back up and made a new high, the time decay on that just crushed it. So went away with all that in my pocket. So that's a good way to do it. So I'll be looking for this trade again. So here's today we're getting this little doji. And if I look at my 1 hour, and if we start rolling over here, I'll probably wait till tomorrow because I want to get that theta decay really starting to accelerate, give me that advantage. Okay, raffle. Let's do the raffle. You're right, man. And one more time, here's the special link if you guys are interested in the course. It's a great package. Okay, wow. Okay, I'm going to pick a quick winner here. Excuse me. Is Freeden 2 here today? Freeden 2. Freeden. That's the first part of his email address. All right, you just won that whole package. So congratulations, and I will be sending that. Let me make sure I get your name right. That's Freeman, okay. Great, Freeman Tyler. Oh, didn't mean to say that. And let me pull that up here. Okay, got it. Okay, well, thank you very much for being here today. And I hope you guys learned something and can, use it tomorrow. And thank you very much, Morgan. Third time was a charm, so appreciate you hanging in there with me. So I can't really hear anything back, but please send me an email if you have any questions. That's support@powercycletrading.com, support@powercycletrading.com. Thank you very much.